This week on Wealth Track, we go on an exclusive treasure hunt with small cap pioneer Chuck Royce. This great investor scours the globe for financially strong, well-managed leaders in their fields that deliver above average results. Finding small company gems is next on Consuelo Mack Wealth Track. Small caps peaked back in June of 2015. And the Russell 2000 lost 25.7% of its value. I got this off the Royce website from that high to a February of 2016 low. Right. And I say low because you say, and Royce, your team at Royce says, that you think that February was the low for small cap stocks. Why?
We do think it was, and obviously it's not for sure.
Right.
But we do think it was. Having a decline of 20% plus is universally, or at least historically, would appear to be almost every time you've had those circumstances, you've had a very strong 3-year period afterwards. So we're sort of relying on history.
Right.
And this decline exceeded 20%, and in the 20% types of decline, you do get many stocks, certainly half the stocks are declining more. So you actually get a huge set of opportunities.
So you're finding more opportunities now in the small cap universe than you did, let's say, 3 years ago?
Well, certainly
5 years ago,
in the
whatever.
stocks we like.
Okay.
We were not in biotech at all.
Right.
We were not in some other categories at all.
And that's a decision based upon what?
Our own feelings that we have to stick with a reliable type companies that have earnings. So
Right.
we very much believe in sort of the old-fashioned fundamentals count. Fundamentals are things we can touch and see, earnings, free cash flow, et cetera. That's all we do.
And how challenging has money management become? Is it more challenging now than it was, when you started the Penn Mutual Fund, when you took over in 1972? How has it changed?
It is definitely more challenging. Mm-hmm. There are new vehicles. ETFs have changed the marketplace. Passive investing has been taken way too seriously. So there's been fundamental change going on. Active management, which is what we do and
Right.
many others, has underperformed as passive did very well. And this is changing. This is value investing and active investing really are highly correlated. So as value does better, so will active managers.
And why is that, Chuck? Why are they so highly correlated?
Because I think a really good active manager is always sort of in the risk management business. So he's always taking steps to reduce risk, which works most of the time and in the long term. But in the last period when markets skyrocket, was not the best strategy.
We've come through a period since the lows after the financial crisis where everything went up essentially, mm-hmm. and more speculative companies went up more than
yes.
than companies that were kind of more solid and
mm-hmm.
higher quality. And you're saying that's a major reason why active managers
yes. I think active managers in general are risk adverse or mm-hmm. managing risk. Mm-hmm. And any step you took to manage risk in that straight up market reduced returns. And it's almost that simple.
Yes, and therefore, as we enter a period where financial quality is going to matter more because it's a more difficult economic environment for a lot of these companies, and if interest rates start going up and they're not going to get free money essentially, that you think that active managers are
risk management will be rewarded, not penalized. And that's already taking place. We had a terrific opening 4 or 5 months of this year, as did many value managers, and as did many active managers.
And as far as an investor's point of view, and you're seeing the flows of money leave active equity managers such as yourself and go into passive strategies. Do you think that this is going to hurt investors in the future, or are you concerned about the kind of risks that they're exposing themselves just in investing in the market as a whole?
I do see that actually in our space, in the small cap space, the Russell 2000 is made up of 35% of money losing companies that you probably would not want to invest in. So by strictly going passive, you don't know what you're getting. An active manager would be you'd be managing a portfolio of probably higher quality, more fundamental type companies. So I do think it's night and day in the small cap space.